So we've previously learned that cash is really important, just as important or if not more important than profit. We've learned that we need to make a cash flow statement to do that, and it has 3 sections. So let's look at how we actually make one by looking at the format. So a cash flow statement isn't like a balance sheet. A balance sheet is a report that's as at, so it continues forever and it just goes forward. We make a new balance sheet at a certain point in time. So that continues from one period to the next. An income statement, we looked at that earlier and said an income statement is something that's actually prepared for each period. So we have an income statement for period 1 and we say for the period ended, income statement for the period ended in period 2, and income statement for period 3. Well, a cash flow statement is actually not like a balance sheet. It's like the income statement. We make a separate cash flow statement for each period. So at the top, we're going to use the words for the month ended or period ended, however long the period is. It's not an as at report. And what we do is we start with our operating activities. We then put in our investing. We put in our financing, and then that leaves us with this section at the end where we write, just looking at the sections above, we have our inflows. They go on top and they go in as positive numbers. We've got our outflows. They go underneath the inflows in each section, and you can see negatives in a cash flow statement are expressed in brackets. This is the only report where we want brackets. Don't want to see brackets for expenses in the income statement or liabilities in the balance sheet. Brackets only go in the cash flow statement, and that represents an outflow of cash. So the cash flow statement, it's important to realize that each thing is listed based on its nature of the cash flow rather than the name of the ledger. For example, I would write receipts from debtors rather than debtors control. I would write GST received or GST paid and not the name of the ledger, which is GST clearing. I'd write payments to creditors instead of creditors control. I'd write cash purchases of stock instead of stock control, and I'd write purchase or sale of vehicle instead of vehicle. The point being that these items or these descriptions over here, they're descriptive in nature. They actually explain what happened, whereas these ones over here simply just say the name of the ledger that's been affected. So we don't want to do that. We want to make these things descriptive about the nature of the cash flow itself. That leaves us with each section. We need to add up what's called the net cash flow. So we can see net cash flow from operating activities, net cash flow from investing, net cash flow from financing, and that's simply the total of the inflows minus the outflows for each section. So 129,000 less 106,700 equals 22,300. 2,000 less 31,000 is negative 29. 60,000 less 23,000 is $37,000, and so on. So that's how we get the net cash flow for each section. The final section needs to be set out in this way. We start with net increase or decrease in cash. So in this case, it's gone up 30,300. That's simply the sum total of the 3 sections. So I'm adding up the operating activities, net cash flow from financing activities, and the net cash flow from financing and investing, for a total of 30,300. I then add that to the bank balance at the start of the period. So this business had $2,000 in the bank at the start of the month. Now they made 30,300. So at the end of the period, we finish with a total cash of $32,300, and that's the amount that would show up in your cash at bank ledger in the balance sheet.